Welcome to the deep dive. Today, we're going to unpack the thinking of two absolute legends in investing, Warren Buffett and Charlie Munger.
That's right. We're drawing from the University of Berkshire Hathaway.
And to kind of set the scene, imagine this. You put $1,000 into the S&P 500, say, back in 1965.
Okay.
By now that the $1,000 would have grown, well, you'd have a 12,717% gain.
Wow. That's significant.
Yeah. It's like turning the cost of an old 19-inch Zenith TV into a brand new Volvo V60 today.
Pretty good, right?
Definitely a solid return, no question.
But okay, here's the kicker. What if you'd put that same $1,000 into Berkshire Hathaway instead?
I think I know where this is going.
That initial $1,000, which was about the price of a Barbie doll back then, well, it would also let you buy that same Volvo today.
It's just mind-blowing, the level of compounding they achieve.
Absolutely. I mean, Berkshire's huge now. Only 5 companies worldwide have a bigger market value, and it's the biggest conglomerate, owns all these famous brands.
So the big question is, can we actually learn from them? Can we apply their wisdom?
I think we absolutely can. And that's what we're here to do, right? This deep dive is all about that.
Okay.
We're using Daniel Pecaut and Wrenn's book, The University of Berkshire Hathaway. They basically sifted through every word Buffett and Munger said at 30 years of shareholder meetings.
30 years. That's incredible.
It is. It's like the ultimate masterclass. So our mission today is to pull out their top 5 takeaways, the big ideas that can help you become a smarter investor.
All right, let's do it. Where do we start? Takeaway number 1.
Takeaway 1, how to invest when inflation is high.
Okay, very relevant. Inflation. It's kind of the silent killer for investors, isn't it?
Totally. You think your portfolio is up 10%, which sounds great.
Yeah.
But if inflation is also 10%, you haven't actually gained any real purchasing power. You're just treading water.
Right, running hard but staying in the same place.
Yeah.
And with interest rates being so low for so long, and now inflation picking up, this is crucial stuff.
It really is. So what do Buffett and Munger say not to do? What should you avoid?
Okay.
Well, first, they're wary of holding currencies. Governments print more money, the value tends to go down over time. Makes sense.
Simple enough.
Second, bonds, especially traditional bonds with fixed payments. As inflation goes up, the value of those future fixed payments goes down.
So investors demand higher yields to compensate. Got it.
Exactly. And third, this one surprises some people, gold.
Gold, the classic inflation hedge. Or is it?
Well, they argue that while gold holds value, it doesn't produce anything. It just sits there, like land or a famous painting. A kilo of gold is still a kilo of gold years later.
Right. It doesn't generate earnings or dividends.
Precisely. So over the long haul, the returns tend to be, well, mediocre compared to assets that actually do something.
That reminds me of the anecdote in the book about the Van Gogh painting Sunflowers.
Oh, yeah. Tell us that one.
Sold for a record $40 million back in 1987. Huge news then. But if you calculated its return per year since Van Gogh actually painted it, it was only about 13%.
Only 13%.
Which sounds okay until you compare it to Buffett and Munger's like 20% average annual return over decades. It just shows the difference between static assets and productive ones.
That's a perfect illustration, which leads directly to what they say you should invest in during inflation.
Okay, what's the good stuff?
Productive assets, primarily companies, businesses in the stock market.
And not just any business, right?
Definitely not. They look for businesses that need relatively little capital to operate and grow, and, crucially, they need pricing flexibility. Pricing power.
Why is that so important?
Because if a company needs tons of money just to stay in business, constant upgrades, new factories, even if they can raise prices with inflation, all that extra profit gets eaten up by reinvestment.
Okay, so you want businesses that don't need constant cash infusions.
Right. And you want them to be able to raise prices without losing customers. If you're selling something generic, a commodity, good luck with that. You'll likely get squeezed.
And the classic Buffett example here is...
But to be See's Candy.
See's Candy, right. Bought it in 1971. Revenues were $25 million. Tangible assets only $9 million.
Get this. 40 years later, revenues hit $300 million.
Wow.
But tangible assets only grew to $40 million.
So let me get this straight. They only needed an extra $31 million in assets.
That's it.
Over 40 years. To generate an additional $275 million in revenue each year.
Exactly. It barely needed any capital. And everyone sees they could raise prices and people still bought the candy. Perfect inflation-resistant business.
Incredible.
And there's one more ultimate inflation hedge they talk about.
What's that?
Investing in yourself. Improving your own skills, your earning power, like becoming the best surgeon or plumber or whatever in town. Your value keeps up with or beats inflation. We'll touch on this again later, actually.
Okay, good point. So handle inflation by owning capital-light businesses with pricing power and by boosting your own skills. Makes sense. What's takeaway number 2?
Takeaway 2 is about risk. What is investment risk, really?
Yeah. Because the standard definition, what they teach in finance class.
Volatility, price swings.
Exactly. If a stock price jumps around a lot, it's risky. But Buffett thinks that's, well, you said it earlier.
He calls it silly.
Silly. Right. Because think about it. How can an investment that bounces between maybe a 20% gain one year and an 80% gain the next? How is that more risky than something that just plods along giving you 5% every year?
It doesn't make sense from their perspective. For Buffett and Munger, risk isn't about how much the price moves day to day.
So what is it then?
It's the possibility of harm or injury. That's their definition. Something that can permanently damage your investment returns. Wipe you out.
Okay, permanent damage.
Yeah.
Not just temporary dips.
Right. If you're buying and holding for the long term, like Buffett, market swings don't really matter much. What matters are things that can fundamentally impair the business itself.
So what kind of things are they looking at?
They focus on 3 main types of business risk. First, the capital structure. Too much debt, too much leverage.
Debt is dangerous.
Hugely dangerous. High leverage magnifies mistakes. Buffett has that great line. Anything times 0 is 0. One bad move fueled by debt can bankrupt you permanently.
Okay, so watch the debt levels. What's the second risk?
Capital requirements. This ties back to inflation, actually, a business that constantly needs huge amounts of capital just to stay competitive.
Like airlines or heavy manufacturing, maybe?
Could be. Those businesses are inherently riskier. If there's a financial crisis or a downturn, they might struggle just to find the cash to keep operating. Liquidity risk.
Right, needing cash when nobody wants to lend, that's bad. And the third?
Commodities. Businesses selling undifferentiated products. Think basic chemicals or maybe some agricultural products.
Where price is the only thing that matters?
Pretty much. These companies have no real pricing power. They're vulnerable to brutal price wars. And in a price war, usually only the lowest cost producer survives. It's a tough, risky game.
So risk isn't volatility, it's debt, high capital needs, and being stuck selling a commodity. That's a very different way of looking at it.
It really is. It shifts the focus from the stock ticker to the actual business.
Okay, so if we understand these real risks, how do we avoid them? How do we find the good companies? Which brings us to takeaway number 3, I guess.
Exactly. Takeaway number 3, invest using filters.
Filters, like sieving for gold.
Sort of. Charlie Munger has a great quote. Few humans have an edge if they follow 40 companies or more.
Focus is key.
Absolutely. You just can't possibly understand dozens and dozens of companies deeply enough. So you need a way to narrow down the field, to filter out the noise.
So what are their filters? Do they have like a checklist? PE ratio under X, ROA over Y?
Well, interestingly, no. They don't really push specific generic financial ratios like that.
Why not?
Because they recognize that industries are different. What looks good for a software company might look terrible for a railroad and vice versa. A single set of ratios doesn't work universally.
Okay, fair enough. So no simple checklist. What filters do they insist on?
They have 2 absolutely mandatory filters, non-negotiable. Every investment has to pass these 2 tests.
All right, what are they?
First, great management.
Great management. Okay, what does that mean to them?
It means executives who are not just competent, but also ethical. And critically, they have to consistently act in the best interests of the shareholders. All shareholders, not just enriching themselves.
So trustworthy leaders who think like owners.
Exactly. If they don't trust management or think they're self-serving, they just won't invest. Period.
Makes sense. What's the second mandatory filter?
The famous circle of competence.
Ah, yes. Know what you know and know what you don't know.
Precisely. You have to have a pretty good handle on how that business is likely to perform over the next, say, 5 or 10 years. You need to understand its economics, its competitive landscape.
And just as importantly, know the limits of your understanding.
Yes. Be honest with yourself about what you don't understand. If you can't reasonably predict the future of that business within your circle, stay away. Don't pretend.
And they really stick to this, don't they?
Yeah.
Like, historically, Berkshire avoided tech stocks for a long time.
They did. And pharma, too, because they felt it was outside their circle of competence.
I remember that quote from Buffett during the dot-com bubble in '99. He joked that if he asked business students to value an internet company for an exam,
Yeah.
anyone who actually gave him a value would fail the course
Yeah.
because he felt nobody could rationally value them back then.
That perfectly captures their discipline. If they don't understand it, they don't swing.
It's tough discipline to maintain, though, especially when everyone else seems to be making money in a hot sector.
It is, but it's core to their long-term success. Oh, and Munger had another related insight back in 2017. He said, you must fish where the fish are.
Fish where the fish are. Meaning?
Meaning look for opportunities where they're likely to be found. He contrasted the potential he saw in markets like China, lots of fish, or opportunities, with the U.S. market at the time, which he described as having too damn many boats.
Too many boats. So too much competition, too many investors chasing the same deals.
That was his implication. Harder to find bargains when everyone's looking in the same place. It relates back to filtering. Maybe you need to look where others aren't, or where you have a unique insight. Within your circle, of course.
Right, find your own fishing spot.
Ah.
Okay, so great management, circle of competence. Those are the key filters. What's next? Takeaway 4.
Takeaway number 4, the share of mind principle.
Share of mind. Okay, let's try a quick experiment. I'll say a product type, and you listening, just say the first company that pops into your head. Ready?
Okay.
Soft drinks.
Pause.
Shaving blades.
That's
Smartphones.
pause.
Ketchup.
Yes.
Kids' movies. Okay, did you think Coca-Cola, Gillette, Apple, Heinz, Disney?
Probably most people did, for at least some of them.
Exactly. That's the share of mind principle. These brands are just so dominant in our thinking. They're almost the definition of the product itself.
And it's absolutely no accident that Berkshire has owned big stakes in companies just like these. Coke, Gillette, Apple, Heinz.
Right. Because that share of mind gives them huge advantage, doesn't it?
A massive advantage. And it boils down to pricing power.
Pricing power again. It keeps coming up.
It's central to their thinking. If you're thirsty and you specifically want a Coke, not just any cola.
Or your kid wants to watch a Disney movie, not just any cartoon.
You reach for that specific brand. You trust it. It occupies that space in your mind.
And the amazing thing is, it almost doesn't matter if Coke costs, say, 20% more than the store brand.
Or if the Disney movie ticket is a bit pricier, you pay it because you want that specific thing that holds the share of your mind.
That's incredibly powerful for a business.
Immensely powerful. Buffett sums it up really simply. If share of mind exists, the market will follow. The sales, the profits, the customer loyalty, it all follows from owning that mental real estate.
Wow. Okay, share of mind. That's a great concept.
Yeah.
Which leads us to the final takeaway, number 5.
Number 5. And arguably, this might be the most important one of all.
Okay.
Invest in yourself.
Invest in yourself. You are your own greatest asset.
Absolutely. You know, people often talk about saving money. Like in The Richest Man in Babylon, always pay yourself first, save 10% or whatever.
Right. Financial compound interest.
Which is hugely important, don't get me wrong. But Charlie Munger took it a step further. He talked about discovering mental compound interest.
Mental compound interest. How does that work?
He made it a habit, he said, to dedicate the best hour of the day to improve his mind. Reading, thinking, learning. And only after that hour, he said, the world could have the rest.
Wow. Dedicating the prime hour of the day just to learning.
It wasn't just passively reading either. It was about connecting ideas from different fields, building mental models, constantly challenging his own thinking. That's the compounding your knowledge base grows and interconnects over time.
And this loops right back to what you said about inflation, doesn't it?
It does.
Investing in yourself, making yourself more valuable in the marketplace, becoming that top surgeon or engineer.
That's how you ensure your income keeps pace with, or hopefully exceeds, inflation. You're compounding your human capital.
Buffett did this too, right? Even from a young age.
Oh, definitely. The stories are legendary. Spending hours and hours in the library as a kid.
Reading every book on investing he could find.
Some of them twice, apparently. Just absorbing everything, comparing different ideas, figuring out what made sense to him, building that internal database of knowledge.
So it's not just about starting early with saving money. It's also about starting early with learning.
Yes, they really stress that. Make your investing mistakes when you're young and the stakes are small. Learn from them.
And build that database of great stocks in your mind, as they put it.
Exactly. Constantly be learning about businesses, industries, how things work. That mental catalog becomes invaluable over time. It's about relentless self-education.
Okay, so let's quickly recap those 5 big takeaways from Buffett and Munger.
Let's do it.
1. Beat inflation by investing in businesses needing little capital, but having lots of pricing power.
2. Real risk isn't stock price volatility, it's the chance of permanent loss due to things like debt or poor business fundamentals.
3. Use filters. Focus on great management and stay strictly within your circle of competence. Don't chase things you don't understand.
4. Look for companies with strong share of mind. That brand power often translates directly into pricing power and lasting success.
And 5, maybe the most fundamental, your best investment is always, always in yourself. Compound your knowledge and skills.
That's it. And when you look at these principles together, they really show that deep focus learning, building that mental compound interest is maybe the most powerful tool you can develop, not just in investing, but in anything.
That's a great final thought. This deep dive is really just scratching the surface, isn't it?
It is. It's an encouragement, hopefully, for you to keep building your own knowledge, your own mental toolkit.
Absolutely. Keep doing your own deep dives into whatever sparks your curiosity. Thanks for joining us today.